Hey, this is Lon Welsh at Ironton Capital. How would you like to get more diversified with your portfolio or your self-directed IRA with more passive diversified real estate investments? How many of you want to get off the 1031 treadmill and go from active to passive real estate investing and while managing your capital gains exposure? I've been hearing this a lot, and that is what we have developed for you. Here's a quick note from our attorney. There's some confidential information in the presentation. Do feel free to share it with your financial team. Any type of investing involves high risk, so you want to be sure that you evaluate it with your team before deciding to invest. Nothing in today's presentation is an offering of an investment opportunity. If you do find this to be of interest, we would be delighted to send you the actual subscription documents so you and your financial team will have all the details. There's lots of forward-looking statements, so you'll hear words like may, will, should, expect, plan, seek. This is based on our analysis of the market, information we've received from sponsors, our analysis of their information, and you'll want to do your own, of course, analysis of those things yourself. We talked about company-sourced information. So with that out of the way, Ironton Capital, the investment committee consists of myself. I've been investing in commercial real estate for a little over 20 years. Brent Geyer, who's done a ton of real estate acquisition and development also over 20 years, and he was a CPA before that at KPMG. And Richard Landry comes to us via Goldman Sachs and used to run a $2 billion family office as the chief investment officer. So the three of us review all the investments that we share with you. So here's a typical situation I tend to find pretty often is that people have got a self-directed IRA that's got limited partner investments in syndications of real estate or something similar. So there's a minor amount of UBIT tax insurance. So what you want to do is set aside some of the gains that you get from your profit, quarterly dividends in your account so that you can pay those taxes as they come up. That's an easy way to manage the UBIT exposure. A bigger problem, though, is that self-directed IRAs and all traditional IRAs, even though the majority of your income generated by the fund might be long-term capital gains, which would be at a lower tax rate, when you take the money out, you're going to be taxed at ordinary income tax rates. And that differential tax really is a huge hit. Another problem with a lot of IRAs is that when you finally get to be retirement age, there's an RMD, a required minimum distribution, that you've got to take out of your IRA each year because, of course, the IRS wants their tax cut. And if all of your investments are in long-term real estate positions, you may not have the liquidity to take out the RMD. So what can you do to manage all of this a lot more efficiently? And the answer is move your IRA to a self-directed IRA, invest in real estate limited partnerships. Our long-term diversified fund would be one example, but there's certainly other great firms out there like us. And then after you've been in for about a year, you get what's called an FMV, a fair market value assessment from your CPA. There are CPAs who specialize in this. Not many of them do it, but if you want, I can refer you to the guy that did this for me, and I'm going to walk you through the whole case study here in the next couple slides. They will be able to help you legally write down the value of your investment, your basis, by at least 35% or perhaps a little bit more than that. And then you convert to a Roth IRA, and then the tax bill you have to pay gets cut quite a bit. And then as a Roth IRA, you're not going to be bothered with these required minimum distributions or some of the other headaches that people tend to have with using a self-directed IRA to invest in a long-term investment. And the tax savings are enormous, as I'm about to show you. So let's do an easy hypothetical portfolio with a $100,000 balance. And I'm saying that you're 45, you're in stock funds at Charles Schwab. You want to retire at age 60, so 15 years from now, so you've got 15 years of compounding. You want to take out cash until you're 80 years old and roughly like use up all the cash. So we'll look at a couple different scenarios, using a self-directed IRA and investing in our long-term fund. And then I'll also look at what if you do that, plus you do the fair market value study that I discussed, convert to a Roth, pay some taxes today, and then be tax-free for the rest of your life. And I'll show you just how important this tax strategy actually is. So if you are in this situation, you find this to be of interest, set up a conversation time with us, just book an appointment, and we'll do a quick financial model for you. And these are the user inputs I'll need to know from you. How much is in the IRA, the growth rate for the S&P 500. Historically, that's between 9 and 10%. If you've got a stock and bond portfolio, I would recommend 7% as the historical to use. What's the marginal tax rate in retirement. So if you're relatively high income, that might be 35%, but based on your expected income in retirement, we can look up the tax table to see where you're at. We have to put in the growth rate for our fund or whatever you choose to invest in. Our usual target for our long-term funds is 17 to 20% a year. The next variable is how much will we be able to write down the value of your IRA when you do this fair market value study. It's going to be somewhere between 35 and 50%. And then what tax rate will you have to pay on your Roth when you do that conversion? Those are the variables that we need, and then we can give you all the rest of the answers from it. So here's the starting point here. So on the up and down axis, you see we starting at 2023, and then I've got 5 years, 10 years, and then a couple more years after that. So if we do nothing, we've got $100,000 in our fund at the starting point when you're 45 years old. We just have a stock portfolio making 10% a year, and you can see that in year 1 it's a $10,000 gain. In year 5 it's $16,000 due to compounding interest, and by the time we get to 2038, it's been compounding for you for 15 years. So instead of being 45 years old, now you're 60 years old. We've grown this to be $411,000. So your $100,000 stock investment will quadruple in value over 15 years, which is fantastic. And I just solved for if we withdraw about $48,000 per year during the 20 years of your retirement when you need that money, we'll be able to use up almost all of the cash in the account. So the total cash that's going to be delivered to you is just a hair over $1 million, and you're going to pay $350,000 of tax with the assumptions that we started off with. So your after-tax spending capability is $655,000. Nothing wrong with this. This is fantastic. So the next thing I want to look at is say that you move your money to a self-directed IRA, and instead of being in the stock and bond portfolio, you do our long-term diversified fund. And your $100,000 today is going to compound to $3.8 million over your lifetime of gross returns, and the IRS is going to take $1.4 million of tax, and you'll be left with $2.5 million. So to recap, the stock portfolio gives you $655 after tax, and our fund would give you $2.5 million. And of course, that's a projection, not a guarantee. Just like the stock market's a projection and not a guarantee. So another possibility is you move the money to your self-directed IRA, invest it in our long-term growth fund, and then we're going to do a Roth conversion after about a year. And I'm assuming that that's going to be about a $22,000 tax bill that you'll have to pay today. What's going to happen then is you are going to grow your portfolio and take out distributions of $3.1 million, and you're only going to have $22,000 worth of tax. So let's compare that. If you don't do the Roth conversion, you'll have $2.5 million after tax, so we can generate an extra $600,000 on an after-tax basis. So just to recap really quick, how much after-tax cash will you have available to spend each year? I think I did explain this correctly. Yeah. So estimated after-tax cash available to spend. If you do nothing, this is the right-hand chart, it's about $156,000. If you invest in us, it's going to be like $238,000. If you do the Roth IRA conversion, it's $299,000. So the after-tax is really a lot better with this strategy. So if you have any questions on that, feel free to let me know, and I'd be happy to go through those with you. So you might ask, what does this fair market value study look like? So here's the study I had for one of the investments that I made, and I just blocked out the dollar amounts on here. In this particular case, it was about a 25% control discount and about a 25% for marketability. So in this case, the CPA's fair market value study showed that the market value was half of what I paid for it. So I cut my tax bill in half by using this approach. So if you're currently, in a stock and bond portfolio at Schwab or Vanguard, you'll need to use a self-directed IRA that works with long-term real estate investing like us. There's a lot of vendors out there. We've got hundreds of clients, most of whom are in self-directed IRAs. And we found through trial and error that Madison Trust does a really great job, and they'll give you $100 when you set up an account. I don't get paid for referring them. It's just I found that they were a good partner, and I hope that you'll enjoy working with them as well. So I wanted to talk a little bit about our medium-term income fund and talk about how that's a shelter from volatility. So the sponsor that we're a co-general partner with them. They provide financing solutions for medical service providers and physicians. So if you've got a person who's been in an auto accident, a lot of times they'll have a neck injury, and the smaller medical bills might be 35,000 for someone who didn't get injured too badly in their case, in their accident. And it may take 12 or 18 months for the legal issues to be resolved about which of the two insurance companies is going to be liable to pay for this medical treatment. For a smaller file like that, it's not worth it for the hospital or the clinic or the doctor to fight with the insurance companies and do all the ongoing paperwork. So what our sponsor partner does is they take over responsibility for all of the billing and insurance paperwork, and they advance about 30 or 35% of the value of the claim to the physician or clinic at the time that they take over the file, and then the physician is just done with it. So if it's a $35,000 claim, we might pay them $10,000 or $12,000 for that file. We want to work with providers that have a lot of deals like this. So ideally, we'd have like a basket of about 100 of these insurance claims, and we would do an advance on about 95% of them, but they're all cross-collateralized. So we'd expect that 2 or 3% of the insurance claims will turn out to be fraudulent for some reason or another, and the insurance company just isn't going to pay. No problem. We've got 97 other files in the basket that we can collect against. So this would be like as if you owned 100 rental properties and they were all paid off. You came to me as a bank. I gave you a 35% loan-to-value loan on 97 of your properties, but they were all cross-collateralized. So if you default on any one of your mortgages, I can go after any of the other 99 properties to collect. So nothing is bulletproof, nothing is foolproof, but this is pretty good. So the rate we pay to you is between 11 and 13% a year. That depends on the AUM, the assets under management that you have with us at Ironton Capital. And those dividends start right away after the first quarter. What's the liquidity like? Well, it's tied up for 1 year, and then you can get access to capital after a 3-month notice after that first year ends. So what we like about MTI is that it's not correlated to interest rates or the stock market. So if you're not a finance major, you may not be familiar with the concept of financial correlation. So I'll walk you through what that means. The gentleman in the middle, his name is Harry Markowitz. He won the Nobel Prize in Economics in 1994, developing the modern portfolio theory. And what he figured out is that if you diversify your portfolio, and if the assets in the portfolio are not correlated, and I'll explain that, you can reduce risk while improving your returns. And he's one of the heroes for all of us in the finance industry for figuring out how to do this, because every client wants to make more money and take less risk. So one way to visualize this is this graph. If you think about the bottom axis, from the left is low volatility or risk, to the right is higher volatility and risk, and on the up and down axis, the y-axis, is the amount of return that you get. Normally, low risk, low return, like a CD at your bank is like almost no risk but doesn't pay very much. Or in the middle of the chart might be like the stock market, some volatility and risk but better returns. And then at the top right might be high risk, high return, and that would be doing one single real estate investment as opposed to a diversified portfolio of real estate investments. And what you found with his theory is that if we got the right basket of non-correlated investments, you could earn the same return with less risk. Or you could decide, I'm going to keep my risk level steady, but increase my returns by looking for a diversified set of assets that are not correlated to one another. So what's correlation? It's just a statistic that measures the degree in which two securities prices move in relation to each other. And they're measured from -1 to +1. So -1 means they're perfectly non-correlated. They move in opposite directions. A +1 means they're perfectly correlated, which means they are always moving in lockstep. What we want, ideally, is something that's close to a 0, where there's no relationship between the two investments and how they tend to perform over time. So here's an example of positive correlation of two stocks. Maybe one of them is Exxon and one is British Petroleum. And the largest, I'm not a stock expert, but one of the large drivers of a petroleum company's stock price is going to be the price of oil. So if oil prices go up, it'll be a favorable impact on both oil companies, and if they go down, it'll be a negative impact. This would be an example where it's a perfect correlation. A negative correlation is where the two stocks always move in the exact opposite direction, and that's actually very difficult to find in real life on a sustained basis. So with our medium-term income fund, there is almost no correlation between stocks and the medical receivable fund. So what I've got here on the left-hand side is a value of a $100 investment on July 1st of 2005, and we're going to look at a 20-year period. And the orange line on the left is the S&P 500 stock index, and you can see over 20 years the stock market goes from a $100 valuation to 520. So it's a 5x return. But it's choppy. It goes up and down depending on what's going on in the economy. The blue line is the value of the medium-term income, and it's the same steady return every single quarter. So it's a very, very smooth line, and it grows to about 890. So it performs a little better than the stock market. On the right-hand side, you can see here's the quarterly returns. So there's 80 different data points, quarterly returns for 20 years, and you can see the stock market is just all over the place, up and down and up and down. It's a roller coaster ride. Where the blue line, which is like at 3.5 or 4%, is just steady every single quarter with almost no variability at all. Medium-term income is designed to be as stable as possible. So what is the statistical correlation between these two assets? It's 0.1. It's almost perfectly non-correlated. So this gets us back to the Nobel Prize winning theory that if we can add in an asset class that doesn't have its price move up and down in the same fashion as the alternative asset class, in our overall portfolio, we can decrease the risk of the portfolio and we can increase the returns. And this is a good example of two securities that are almost perfectly non-correlated. This is the same analysis, but from a 10-year view. I included this in here because when I present this to investors, some people want to see a really long-term view, some want to see a shorter-term view, so I put in both of them for you, so you'll be happy either way. Over a 10-year period, this is July of 2015 through end of June of 2025, a $100 investment in the stock market grew to $301, and a $100 investment in the medium-term income fund grew to $302, so almost exactly the same returns. But again, if you look at the quarterly volatility, lots of volatility in the stock market, almost nothing in medium-term income, and they're almost perfectly not correlated. It's 0.1. So some of you may think, well, gosh, the medium-term income fund is sending out a steady dividend every quarter. Isn't that more like a bond than a stock? And like the answer to that is, yeah, absolutely. So here's a 20-year view looking at the bond index. So I picked AGG, which is the aggregate bond index. It's a really broad basket. We could redo this with, just blue chips or just government treasuries or any other. It'd come up to pretty much the same answer. So what you can see is that if you put $100 20 years ago into the AGG bond index, it grew to 178, and MTI grew to 893. So it's not even close. On the right-hand side, you see the volatility. So the volatility in the bond market, as you would anticipate, is a lot less than it is in the stock market. So if you go back to this 25-year chart on the left, this is for stocks, you can see this index is going from minus 25% to positive 25% for the stocks. If you look at the same chart for bonds, it's going from minus 8% to plus 10%. So bonds have a lot less volatility, which is one measure of risk, in exchange for they have lower returns. What's great about MTI is that it has very, very steady returns, and there's no price volatility to it. So there's no correlation between the bond market long-term and MTI. So that's one more reason why it'd be a nice addition to your stock market portfolio or your overall investing portfolio. So what does it mean to be non-correlated? That means that either one of the investments just doesn't change very much or doesn't change at all in value, or when one goes up, the other one goes down. So here's an example showing this. So maybe you have one company that makes raincoats and other rain protection equipment, and the other company sells sunscreen. That'd be two companies that probably would have their stock price not be correlated very well. So you say that's fantastic. I'd love to add some diversification to my portfolio, but my God, there are so many different asset classes I could pick from. Real estate and high yield bonds and large cap equities and small cap equities and international equities and international bonds. And I could buy platinum futures or pork bellies. So this chart shows you which asset class had the highest return in any given year. And you can see like it's just, it's overwhelming to try to figure out. A lot of financial assets that may be in your portfolio today likely have a lot of correlation between them, which means that they're limited in their power of diversification. So the way that you read this chart, the first column going up and down is a stock index of large companies. So the S&P 500 index would be a really good example of that. And along the bottom, you see emerging market companies. So this might be like the Russell 5000 or something like that. You can see there's a 0.7 correlation between the large companies and the emerging small companies. So even though they're very different sizes, they tend to have stock prices that move in the same way. The average correlation across these different types of assets is 0.3. So you can get a little bit of diversification to take some risk out of a stock portfolio by investing in different sectors of the stock market, but you can't diversify away too much of the risk because the stocks just inherently tend to work in the same way price-wise. So what do you do to solve this? If you take a look at institutional capital, so that would be like a retirement portfolio for a large company or a pension fund, you can see that on average of the 135 trillion of assets these guys are responsible for managing, about 19% has been allocated to private equity, people like Ironton Capital, because our investments tend to be not correlated to the public markets. If you take a look at private wealth, so this would just be, millionaires and billionaires with large investments, they're about the same amount of money, 150 trillion, and they've got some money invested in alternative categories like us as well. Why is it so much less? Well, it's historically been underexposed to alternatives like Ironton compared to institutional investors for a couple of reasons. You may not know about it. The minimum investment might be very high. One of our favorite investments that we like to work with, for example, is Hill Point, and their minimum investment is $3 million, which blocks it out for any small investor. And even someone who's got a net worth of $10 million, the idea of putting $3 million of your $10 million into one investment is just daunting. You probably need to have a net worth of $100 million before that kind of an investment would make any sense to you. So it's the high minimums are really the biggest barrier. And then just, people just don't know about them. So what are some common mistakes that we see investors tend to make? Jumping between asset classes, trying to time the market is the classic #1 problem. Over concentrating in a single asset class, having all of your money in stocks and thinking that, well, some's international, some's big stocks, some small stocks, that's diversification. It helps, but it's not enough. Not diversifying across geographies or strategies or sectors. Not having a clear overarching investment strategy and making sure that all the individual decisions that you make are coherent and consistent with that strategy. Making investments because you can, not because they're necessarily right. And then, of course, under allocating to private assets, which tend to be not correlated like we've talked about. So here we took a look at different private equity investments and how they tend to be correlated to some of the larger choices that people tend to make. And you can see there's large company stocks, government bonds. Those are the common ones most people use. Commodities are kind of neutral. And then on the other side here is what you see for private equity like us. We're not venture capital, we're private real estate and private infrastructure. And you can see there's an awful lot of diversification by bringing on investments like this. Earlier we talked about how our medium-term income fund is pretty much not correlated to large stocks and bonds, 0.01, 0.02. So excellent from a diversification standpoint. So if you look at private equity, how does it perform over the long haul from a return standpoint? So if you take a look at the heavy dark blue lines, that's global private equity net, IRR is internal rate of return, and the blue is the global stock market. And you can see that private equity has outperformed the stock market indexes 5 years, 35 years, and everything in between. And it's also, very stable relative to the stock market. So how can someone like you, as a high net worth household, implement some of these institutional best practices Our medium-term income fund is a building block to help you solve a lot of the challenges that you've got. Earlier I was talking about mistakes that we tend to see people make, and Ironton Capital can help you and your family address a lot of problems. We can help you diversify your risk exposure across less correlated investments. We can reduce your concentration, how much of your portfolio is in the public market. We have a lot of experience that we can bring to help you make good choices. We can try to find investments that offer liquidity regardless of asset class. MTI's got pretty good liquidity, and you get access to private investments through a creative investment structure. So for example, earlier I was talking about Hill Point is one of our favorite investments. It's a $3 million minimum. By bundling over 100 of your investments together, like so I might have 100 investors in a fund. If you each have 30,000 each, collectively I've got 3 million, and I can make that investment in Hill Point on your behalf. What's in your control but not my control is building a plan and sticking to it, not letting emotion get in the way of your investments, and then resisting the urge to follow market or investing fads. So I think we talked about all the things about how the medical receivables fund works. We talked about how we diversify risk. It's 11 to 13% returns. We've paid over $3 million to investors so far. It's always been on time so far. Executive team has over 20 years of experience, which is fantastic. A little bit on our due diligence that we did. I'm going to send all these slides out to you so you can review these in your detail at your own convenience. So don't just take our word for it. What do our investors say? Jay had a lot of investments that were causing headaches. He has been gradually selling down his active real estate portfolio, investing passively with us, and now he says he's on track to beat the returns that he had with his rentals without the headaches that he had before. And you can see some of our other investors who've had success stories. The last one there, Justin, he was able to sell his rentals and then move to Portugal, so he is completely passive and living the life of his dreams, which is very exciting. So we have three major themes for our investing, and occasionally we'll have a fourth for single assets. On the left, the long-term National Diversified Fund, target return is 16 to 20% a year, not any liquidity, diversified portfolio of real estate investing. So for long-haul growth, that's a great choice. If you do need short-term, we didn't talk about that today. We have a short-term fund that pays about 8%, and it's got great liquidity. You just need 30 days notice to get out of it. In the medium term, that's the medical receivables that we talked about. That's got the great diversification to your overall portfolio while paying between 11 and 13%. For a lot of you, that is going to be a large building block for getting quarterly income on a recurring basis. So if this is interesting to you, please go to irontoncapital.com/Madison Trust 100. We'll give you that link to set up your self-directed IRA to get that $100 off if you want to do that. If you'd like to talk about your portfolio or just have investing questions in general, we would love to talk to you. Go to irontoncapital.com/review and set up a time to talk to us. And I'm looking forward to talking to you soon.